where we're headed in terms of an uptrend.
Watch Yorba.tv with Michael Yorba.
Right now, we still have a liquidity crunch.
A new network for the serious investor.
Indicators have to complement each other.
Yorba.tv.
There's good news on the horizon.
Cutting-edge information from the trading floor.
Commodities markets are pretty much in a frenzy.
Live on the web at the closing bell.
Record high in crude today.
Weekdays, 3 to 4 p.m. Central on Yorba.tv.
The risk of loss in trading futures and options can be substantial. Therefore, only genuine risk funds should be used in such trading. Futures and options may not be a suitable investment for all individuals, and individuals should carefully consider their financial condition in deciding whether to trade. Option traders should be aware that the exercise of a long option will result in a futures position. Information herein has been obtained and prepared from sources believed to be reliable. Comments contained in these materials are not intended to be solicitation to buy or sell any of the commodities mentioned. Past performance is not indicative of any future performance. Opinions expressed here are the opinions of the author only, and not the opinion of any firm the author may be affiliated or associated with.
All right, welcome to Commodity Classics. Thanks for joining us. I'm Michael Yorba, your host. Really appreciate your patronage and the letters and the calls and the interaction we've got on the social network. I just want to say thank you to everybody for participating with us on our show. Our first guest today is Jake Bernstein, and we're going to take a little side road with Jake today. What we're going to talk about is psychology, from Jake's perspective, of what it takes to be a good trader, what happens on the positive side, on the negative side, meaning when you're underwater in a trade, how to react in a way that either gets you out of trouble or alleviates the issue, both of which can not necessarily be the same thing in some cases. And then on the second half of the show, Jake's going to sit through this whole show with me. We're going to talk about Jake's stuff in the first half of the show, and we're going to talk about my stuff on the second half of the show. On the second half of the show, we're going to go into the Yorba TV FX Fund, and I've had a lot of feedback here. I've had some very positive reactions. We're going to talk about compound interest schedule, how that works with our portfolio, and obviously we're going to get into the details of it in regards to interest and so on. I think they've got Jake dialed in right now. Jake, you with us, buddy? All right. How you doing?
I'm doing okay. In spite of the bad picture, I'm doing okay. Thank you. And yourself?
I'm doing fine. That looks good. It looks a little bit better. All right. What did you want to talk about today, Jake?
Well, Michael, after being in the markets for 4 decades, you make some realizations about traders and what traders do, and you ask questions about why do traders keep making the same mistakes over and over. Mm-hmm. What is it that prevents people from making money? And over the years, we've heard all sorts of explanations: better research, faster computers, better analysis, spend more time on the markets, get a bigger software program, get a better software program, get a bigger computer, get a faster computer. Get discipline. That's a good one. There are a lot of books that have been written on this subject. I've written a few of them myself. So I think it's appropriate because that is the weakest link in the chain. How does the trader really win? What is the trader doing wrong? Are there problems with discipline? If so, what are those problems? And those are the kinds of things that are worth discussing.
Yeah, now that discipline, as far as I'm concerned, is a really good central theme to build around. Let's, if we can, talk about your personal experience, about how you ended up developing the discipline it takes to win consistently in the markets.
Well, before I do that, Michael, let me say that it's been my honor and my privilege to be on your show. I think that you have been doing a great service to traders, and I wish there was a way to keep you on the air because of all the things that I've seen, you provide some absolutely fantastic answers, quality guests, and it's a good service to people, and I hate to see you go off the air. But anyway, that being said,
thanks.
It took me. You're welcome. It took me about 15 years to realize that it was not a question of having the best trading system. It was really a question of how people apply their trading systems, and if there is a mistake to be made, I've made that mistake. In fact, I've even invented a few that haven't been made, and that's all part of the learning process. The thing that always ceases to, and never ceases to amaze me is people are being told, listen, you want to be a good trader? You've got to get disciplined. Of course you're losing money. You've got no discipline. You've got a great trading system. Why can't you make it work? What's your problem? And people say, look, if you can't get disciplined, you got to see a shrink. You got to see a therapist. You got to lay down on the couch and figure out what the heck's wrong with you. But the real problem, as far as I'm concerned, goes back to the fundamental cause, and that fundamental cause is, where does discipline come from? You can't get it out of a book. You can't get it out of a magazine. You can't have someone sit down with you and say, listen, buddy, you got to get disciplined or you're never going to win money, never going to make money. Mm-hmm. Discipline comes from one source, and that is confidence. If a trader does not have confidence in what they're doing, they're not going to have discipline. If they don't have discipline, they're going to lose money. If they lose money, their confidence is going to go further down the tubes. If their confidence goes down the tubes, they're going to have less discipline, and it's a vicious circle.
Right.
So the first thing that has to happen is someone's got to get a methodology that they are able to feel comfortable with and confident in. And they've got to see it working over and over again, and even when it doesn't work, they need specific answers, such as, where do I get out? Where do I take the loss? How do I know when I'm wrong? The trader who is constantly looking over their shoulder, wondering when they're going to get bitten in the you-know-what, and doesn't know why, is naturally unconfident. And so the normal reaction to that kind of behavior would be a lack of discipline. So it's not a question of finding discipline in a book, no matter how many books you read. It's a question of working with a methodology that gives you specific answers to clear-cut objective methods. And if you don't have those, you're not going to have confidence. You're not going to have confidence. You're not going to have discipline, and it goes round and round from there. It's a long answer to your short question.
Okay. Now let's get into that. Let's drill down a little bit deeper into that. You're talking about developing confidence from having a specific methodology that you trust, which then can give you the confidence to go ahead and stick to a set of rules that you've seen perform favorably for you. Now, some people
Correct.
have different ones.
Correct.
Let's get into Jake, because it's been my experience that really, if you're going to learn how to do this, you need some sort of a successful mentor, or in some cases several, to learn from. And that's what I'm trying to find out. How did you learn to do the things that you do now 40 years later?
School of Hard Knocks, Michael. School of Hard Knocks. I never had a teacher, never had a mentor. And I have found it to be rather interesting and a little disappointing that there are very few people in the business of trading, especially in the professional end of the business, such as the exchanges, who really want to educate the public. And, I'm not pointing fingers, but the bottom line is this. In a business where there's a winner for every loser and a loser for every winner, the more you educate the public, the less likely they are to lose. So where's the incentive? Where's the incentive for professionals to educate the public? I think that's a short-sighted view. So, for example, in the past, I've given talks at the Board of Trade, Chicago Mercantile Exchange. I've given talks at Montreal Stock Exchange and various other exchanges. And usually when they invite me to speak, they send out a memo, and it says, Jake Bernstein will be presenting this and that and this and that, and then underneath it, for members only. So I say, hey, why not open it up to the general public? Why not educate the general public? What's wrong with that? There's always going to be a fresh crop of people coming into the markets who, for lack of education or lack of discipline or lack of ignorance, will be glad to contribute their money to this big closed-end pool of money, the zero-sum game that we call commodity trading. Mm-hmm. So for me, education really needs to be out there. Somebody might say, okay, well, what about all these courses? And I'm not going to mention any specific names. What about this course and that course, and this one teaches options, and this one teaches trading, and this person does this, and this person does that? The problem with any of those is that they lack objectivity. they get a bunch of people in a room and they say, well, here's the chart. Looks like the market wants to go down, and so if it doesn't do this, then we'll think about doing this, or we'll measure this trend line, but there are no rules for where the trend line goes, and if you use a fat pencil, you get a fat line. It'll connect more bottoms or less bottoms. It's a matter of opinion. It's a matter of perception. 10 people looking at the same line will have 8 different opinions. That doesn't work for me. So for me, since I'm not psychic when it comes to the markets, the only thing that worked was hard and fast, completely objective rules, wrong or right, rules that I can go back to the computer with and say, does it really work?
Well, when you back test something, how far back do you feel comfortable would give you at least enough data to form an opinion of you trust this or you don't?
Excellent question, Michael. 2 ways. Number one, as far back as I can get data, or at least 100 trades if I can't get data that goes far back enough. And I'd like to see back testing taking place not only in a bull market, not only in a bear market, but in different types of environments. Bull markets, bear markets, sideways markets, markets that are in transition from bullish to bearish. Those are the kinds of markets in which systems should be tested or indicators should be tested. And unfortunately, for many methods, we find that if we test them going back 5 years and we take some data previous to the 5 years that we tested, there's a deterioration. If we take data and we test for 3 years and we go forward 2 years and out of sample data, we find that many times the method deteriorates. So those are some of the problems that are associated, and we have to find consistent patterns, and there are very, very few. There's precious few patterns that are reliable enough to inspire the kind of confidence we need. But having said that, I'll give you the other side of the coin. And the other side of the coin is you can have absolutely the worst trading system in the world. You can be wrong 70% of the time, and as you know, you'll still make money if you manage your trades properly. Mm-hmm. Which brings us to the next level of significance, and that is, if you got a system, it's wrong most of the time. You're losing 7 times out of 10. The 3 times that you're making money have to be what I call the big kahuna. Mm-hmm. If you can't get those, you're nowhere. So the average trader, what do? They lose 5 times, they lose 6 times. The 7th time they make $300-400. They say, I better take the money now before it goes away and I lose again. They take their $300. 5 days later, it could have been $5,000. And so that in and of itself is the third part of this big problem.
Got it. Hey, before we go into the commercial break, let's, I'd like to roll off a few of these questions that have come up here on the shout box for you.
Sure.
Okay. Let's see here. Greg, today's monthly close slightly above the January high. Is that a clear bull signal for you? Greg, I'm not sure what market you're talking about, but I suspect that is that the S&P or something? Greg, come on back in. TJ, here's one. Jake, your sentiments on the Australian dollar's divergence.
Significant. Mm-hmm. I've gone on record as indicating that I expect a significant top in the Australian dollar versus the U.S. I'm bullish on the U.S. dollar relative to all the currencies except the Japanese yen.
Okay.
So, as I said in the past, I'm bullish on the dollar, bearish on the foreign currencies, and the Aussie dollar is no exception to that.
Okay. Next one, CJ. He wanted to know what happened to the cotton market. It says a couple of weeks ago you thought it would start heading north, but it hasn't. So, from my understanding, Jake, your time frame for most of these markets is pretty large.
I do both. I do the short term, I do the long term, and it's very important to keep track of what a person says, even if that person is expressing a general opinion,
right,
because those things change from day to day. In effect, the cotton has been in a downtrend on my work since the middle of April.
Right.
Nothing has changed there, and an expectation is not a reality. An expectation is what I call a setup. So I can expect cotton to go up and not do anything if I don't have a trigger, and in reality there has been no trigger to buy cotton, and it still is looking bad.
Right. I got it. All right, Jake, let's go into the commercial break, and let's cover more of the psychology of a trader on the other side out. And heck, we can take it anywhere we want to go when we come back, all right?
Okay.
All right, be right back with you, Jake Bernstein, here on Commodity Classics.